Hello everybody, my name is Brett Immel with Growth Equity Group, based here in beautiful Chicago, Illinois. Today I'm going to discuss who our company is, what we do, why we do it, and how you, the investor, can benefit from what our firm has to offer. So what is our purpose? We purchase developments in emerging and re-emerging markets throughout the United States. We're a nationwide real estate investment firm. We are not buckled down in just one or two markets throughout the United States. What we do is we follow real estate trends, we follow the job market, we follow everything that's going to make for a great real estate market, not only today, but in the future, that you can benefit both cash flow and long-term appreciation in these markets. This is a little illustration of our website here. It's www.growthequitygroup.com. Check it out. We're constantly updating it with new inventory. Our blog is updated almost daily. We're writing about what is happening in real estate markets, what are the trends in those markets, and why Growth Equity Group is making purchases in those markets. Now, we're not only real estate developers or buying real estate developments, we're also property managers. We understand when you're buying real estate that you want to avoid the headaches of owning real estate. So what we have here based in our Chicago office is in-house property management. Every property that we sell comes with a dedicated professional in our office that will manage your property for you. Now you say, how do you do that from Chicago if your manager's in-house in Chicago, here in your office in Chicago? And the answer to that is we have property managers on site on our properties. But rather than you having to chase down a maintenance man on a property or the property manager that's busy with the tenants on site, we have that dedicated manager for your account right here in-house. Another great thing that we have, it's called gegmanager.com. This is our online portal. Similar to if you had a Charles Schwab account, stocks, bonds, and mutual funds, you could simply log in to gegmanager.com, put in your username and password that you get when you close on the property, and you can see how your property is performing 24 hours a day, 365 days a year. You also can communicate with your in-house manager directly within that portal. Now, what you're going to see is you're going to see your gross rent, your leases, any expenditures that you had for the month prior. It's all going to be right there. So we're trying to make owning tangible real estate, whether it's in your retirement account with a self-directed IRA or outside of your retirement, nothing different than looking on your bank statement or Charles Schwab stocks, bonds, and mutual funds. Again, gegmanager.com. Take the time. It's right on our website, illustrations on how it works. And then once you own real estate with us, you would get your username and password and be able to check out how your property is performing. Now, I'm going to bring up some recent news about our firm. This is the Virginia Business Weekly right here, talking about our recent acquisition, Midlands, right there in Williamsburg. We have another press release here in Yahoo Finance. Yahoo Finance is talking about some of our latest acquisitions in Virginia as well. Now, a lot of people right now are going to say, Brett, well, why is all this news in Virginia? You just said again that you're in Chicago. Remember, we're a nationwide real estate investment firm. See, our firm is heavily invested in Virginia right now, and I'm going to throw out kind of a random question. How many people watching this right now have heard of the Panama Canal? Probably everyone, right? How many of you have heard of the $6 billion Panama Canal expansion? Well, I have. We've been researching this since 2009. The Panama Canal is going through a $6 billion expansion. We all know that the Panama Canal was a shortcut for the eastern seaboard to get the ships up through Panama up to the eastern seaboard of the United States. More or less a shortcut, right? Well, what is happening now, or what has happened in the past 25 years, is these box and container ships have got so big, so wide, they haven't fit through the current Panama Canal. So Panama is going through a $6 billion expansion, putting in this brand new project here. It is the widest, deepest channel in the world, and it's going to allow for these, what they call post-Panamax ships, to be able to utilize the Panama Canal once again. What they're expecting is to have the port of LA to lose 25% of its business over the next 4 to 5 years. I know if you're on the West Coast, it's bad news, but as a real estate investor, this is a great opportunity for you. So these ships, which the port's going to open, or the canal expansion is going to open at the middle of 2016, there's one port on the eastern seaboard of the United States right now that will allow for these box and container ships to come through and port and empty all the goods and cargo. And guess where that port is? Yep, a lot of you probably guessed it. It's the Port of Virginia. So professionals are expecting a double-digit population growth in the greater Hamptons Road area. What does this mean as a real estate investor? Well, what I see is jobs, jobs, jobs. And I've always followed jobs in any of my real estate investments. Why? It's very simple. It's supply and demand. Think about it. One small submarket, a secondary market in the United States, is going to see double-digit population growth over the next 4 to 5 years. Does it make sense to be a real estate investor there today and to be a seller there in 4 and 5 years from today? Absolutely. You see, a lot of people do not know that this is happening. This is a secondary market. It doesn't make the news like a Miami or a Phoenix. This is just a small little area of the country where our firm has indicated is one of the hottest markets that our real estate investors are going to benefit from greatly. This is one of our acquisitions that we had at the end of last year. Timberwoods Townhomes, right in Newport News, right down the street from the Port of Virginia. Look at this. An investment of over $700 million in distribution centers. Think about that. So when the post-Panamax ships come up to the Port of Virginia, they unload their goods. Who's going to be there to unload those goods? Well, jobs, right? Those are new jobs. And then where are they going to put them? On rail? Rail is expanding in this area right now. Trucking. Roads, I spend a lot of time in this area of the country. It's difficult to get around right now because the municipalities are coming in, they're widening roads, they're bringing in new roads. But what does that say to me as a real estate investor? Jobs, jobs, jobs. What else? Distribution centers. They have to put the goods somewhere. Warehouses. It's going like hotcakes right now. Whole Foods just paid 50% above market for dirt to build on in this small sub-market. What does that mean for you as a real estate investor? Supply and demand. It is so important to be investing where the jobs are not there today, but they're there, and then there's more coming. Does that make sense? Absolutely. So, of course, Huntington Ingalls is located right here at the Port of Virginia. Okay? Huntington Ingalls is the largest employer in the state of Virginia, employing over 30,000 people and growing. Is that a good place to be investing in your real estate? Absolutely. The naval base. There's over 40,000 individual military individuals in this area as well. The largest military presence in the United States. So when we're looking at investing in real estate and we're saying what is important, number one being jobs, supply and demand, but if I can have the right tenants being military, some of our favorite tenants, about a third of our clients, or tenants, I call them clients, are military. And why is military so great to have? One, they have a great paying job. They're responsible. Here's number 3, and one of my favorite, is when we have a military tenant in our properties, we get the ranking officer's information. So if anything was to go wrong, if you weren't to get a rent payment by the 5th of the month, who's going to get a phone call? The ranking officer? Who doesn't want the ranking officer to get a phone call? Yes, absolutely. So what does that mean to you? That's a safety net, right? Why we love real estate so much and tangible real estate so much is it's contracted. We have a contract. We have a lease. We can look at our returns. And then guess what? We can select who those tenants are. I'll talk more about property management a little later. But again, the Port of LA set to lose 25% of the business. I know it's bad news for those on the West Coast, but again, you can take advantage of this. You can take, something going wrong there, losing jobs, where the jobs are going to be replaced on the East Coast. You can benefit from that with your real estate investments. Now, what is our purpose? What is our purpose at Growth Equity Group? Your evaluator. What do you mean by that, Brett? Well, I head up our acquisition team. We evaluate every market within the United States. Do we have time to spend every day analyzing every market? No. But we do our homework. And we have cut down what we call in our office, our hot zones, to about 10 to 12 markets where we think that we're going to see future growth, job growth. What subsequently happens with job growth, future growth, is your property values are going to go up, your rents are going to go up, your overall return on investment is going to be better, it's going to be safer. So we're constantly evaluating markets. Again, right now we have become heavily invested on a very hot zone of the country, again, Virginia. I also forgot to mention the state, Forbes just came out and named Virginia the #1 state to do business in, which is a big deal as well. So right now, with that being a secondary market, we're kind of ahead of the curve. We're seeing a few of the institutions move in. There was 5 apartment deals at the end of 2014 from institutions. But right now, let's keep it quiet, and we're still able to get those great prices and be able to get a great return on investment. We're going to have that huge future growth. Now, next, your lender. We're not necessarily your lender, but everything that we sell comes with a non-recourse loan in place, a pre-qualified non-recourse loan. Now I'm going to stop real quick because a lot of you might say, Brett, what is a non-recourse loan? Which I'll talk about it a little more in the presentation here, but I'm going to give you a quick 10,000-foot explanation. A non-recourse loan is an asset-based loan. It's based on the collateral, it's based on the performance of the property, not your personal financial statement, not your personal credit. Heck, the bank doesn't even look at who you are. They have underwritten the property and gave us terms, rates, and amortization schedules on every property we sell. Subsequently, you can walk in, you could have a bankruptcy, you could have 4 foreclosures, and you could buy real estate with us and get a mortgage. Or our top buying, individual would be a self-directed IRA. Yes, a self-directed IRA. Either a Roth or a traditional. You can use a retirement account to purchase real estate and leverage it. Imagine, if you had $50,000 and you went into stocks, bonds, and mutual funds with an IRA, you had $50,000 in investable money. But with us, $50,000 can get you over a $100,000 piece of real estate, more than doubling your buying power. The non-recourse lender is your partner on the deal without even knowing who you are. Your manager. Like I showed you before, we manage all of our properties in-house here in Chicago, and we manage those on-site managers. We take that headache away from you. We don't want you having to sit up at night, having to think about, I know everybody says it, toilets, tenants, what's happening with your property. We're not going to bother you. We're going to upload everything into your statement. You're going to be able to see what is happening on your property 24 hours a day, 365 days a year. But we're also here to communicate directly with you. If you want to talk monthly about what happened the month prior, that's fine. That's why we have GEG management right here in-house. And again, your partner. We're not brokers, we're principals. We buy and sell real estate. We're not looking to broker a deal, say good luck, let me know if you want to sell, here's my business card with my picture on it. No, we're here. We want to see you succeed. We're going to help you with sales strategies on the backside of this. If you want to do a lease option, if you want to sell or finance, whatever it is that you want to do you want to sell it conventionally? We can help you do that. But we're your partner through the long term of this investment. If you're a 2 to 3 year investor, and that's your goal, or if you're a long-term 10, 15, 20-year investor, you let us know. And we're going to let you know what's happening in the market along the way as well. I'm going to talk a little bit of the evolution of Growth Equity Group, where we've come from, where we are today, and where we're looking to go. I think that's very important. You want to know who you're doing business with, how they got there, what kind of mistakes that we've made along the way. And right around 2003, partners of Growth Equity Group were doing joint venture deals with developers. Doing deals where they would find buyers for things from new construction, rehab, to even pre-construction. See, in 2003, you were able to buy paper, being a contract, putting earnest money up, and then subsequently, months after, selling that contract for a profit. It was pretty incredible. 2005, 2006, we were involved in mortgage origination. We actually owned a mortgage brokerage, originating primarily investment loans for real estate investors, while we are also doing deals with developers throughout the United States. Now, in 2007, we opened an office in Florida, Delray Beach, Florida, along with an office right here in Chicago. Did a lot of deals throughout Florida through 2006, 7, and 8. And through 2008 and 2009, I think we all know what happened. The mortgage products went away. We were pretty fortunate in not owning any real estate in Florida at the time and getting out of Florida at the right time. But we got together and said, what is happening in the United States today in real estate? And we all came to the conclusion it's very difficult. How are we going to make money? How are we going to continue this? Because this is one of the easiest questions to ask a real estate investment company is, how did you survive 2008, 9, and 10? So here's our story. Anybody remember a little storm on the Gulf Coast end of 2005 called Hurricane Katrina? I think we all remember Hurricane Katrina. Well, Hurricane Katrina was ultimate devastation on the Gulf Coast, Louisiana, Mississippi, Alabama, some parts of Florida, as well as some parts of Texas. And it was the Mississippi Gulf Coast that really got hit the hardest. On the Mississippi Gulf Coast, they lost 20% of houses in those Hancock, Harrison, and Jackson County areas right there on the coast. And what happened was, if everybody remembers the time, President Bush got a lot of grief from the general public about how he handled post-Katrina. And the federal government had a law that they had enacted after 9/11 when the Twin Towers were hit that was called the Liberty Zone, that allowed real estate investors to come help New York rebuild, and subsequently giving those investors a 50% bonus depreciation. I know, 50% bonus depreciation. Well, the federal government said, why not take this law and move it down to the Gulf Coast, where real estate investors could utilize that bonus depreciation? Because what was going to happen is that the federal government didn't do anything, didn't enact this law. They were going to have to start building themselves to provide houses post-Katrina. So this was an easy, great way for the federal government to utilize us real estate investors to be able to rebuild the Gulf Coast. It was phenomenal. So what happened is new construction real estate that was meant for rental purposes only by real estate professionals, they were able to take a 50% bonus depreciation. So what we did is we went down to the Gulf Coast and we met all the builders and all the developers and joint ventured with them on the rebuilding of the Gulf Coast. It was an opportunity where we had the bandwidth to go and bring real estate investors from throughout the whole United States that were looking for depreciation, one of the best write-offs, in my opinion, ever offered to real estate investors, to utilize that 50% bonus depreciation. Let me give you a quick numbers example. If you were to buy a $200,000 property on the Gulf Coast at the time, and your land costs represented 10%, which would be $20,000, which you cannot depreciate land, would leave you with a basis of $180,000. Now, traditionally, what you were going to take is a write-off over 27 and a half years on that $180,000, which is great. We love depreciation. But what you were able to take on the Gulf Coast, if you bought a qualified property, you got a $90,000 write-off on ordinary income. $90,000 write-off? Is that a big deal? That was a huge deal. The tax law was actually extended twice, in 2009 and 2010. It expired at the end of 2011. About mid-2009, 2010 is when we were seeing a lot of our clients coming to us and saying, hey guys, we have money in a traditional IRA, in a Roth IRA that we have rolled to a self-directed IRA. And we would love to purchase this GoZone real estate. And after a little quick homework and a few calls to a CPA, we figured out there was no real way that a real estate investor could use tax-free or tax-deferred funds to purchase real estate with the means of taking the ordinary tax write-off from the depreciation. But it also turned on another bulb on our heads. And we got to really digging and seeing what was happening in the self-directed space. There was a lot of dollars entering the market looking to do real estate deals. Heck, only 4% of the population, not 4% of the population, 4% of retirement dollars in tax-free or tax-deferred are truly self-directed, 4%. But 5 years ago, it was 2%. So we're seeing this huge growth in this over $1 trillion sector. I believe it's over $6 trillion in retirement. Everybody knows that real estate is on sale, or at least was on sale. And they wanted to purchase it, which is a great vehicle. Here's the problem. These investors were trying to purchase this real estate and go out and get conventional loans. Well, a conventional loan from Fannie or Freddie, subsequently through any mortgage brokerage, mortgage bank, requires what? Personal financial statement, personal guarantee. That is not a non-recourse loan. An IRA could not be the buyer. So there's two banks, North American Savings Bank and First Western Federal Savings, that specialize in financing individuals with a self-directed IRA. The problem is their capacity. What they're loaning is what is called a portfolio loan, a loan that they keep on their books because there's no secondary market to sell that loan to because, of course, again, there's no personal guarantee. The borrower is your self-directed IRA. There just isn't that product for them to sell to. So what they do is they service it. They keep it on their books. So what does that mean from a banking perspective? Well, that means that the underwriting is very, very stringent. It is done in-house. More than likely what they see is, I know from North American Savings Bank, is it goes direct to the president and the board. They're looking at these individuals coming in, filling out applications, and wanting them to finance their property in their self-directed IRA. We have word that last year North American Savings Bank did about $40 million in mortgages to self-directed account holders. $40 million on a nationwide lending isn't a lot of money. See, this was the problem. We knew it was a problem because as real estate investors, we know that leverage lays in bed together with it very well. So what's the solution? Well, right here. We came out with the product mid-2010. We went to banks, private lenders, and we said, here's the product that we want. Here's the space, the self-directed IRA. The individual is using either a traditional or Roth, rolling it to a custodian, going out and buying real estate, but wanting to leverage that real estate. If we gave you the real estate that we were going to buy to underwrite prior to you giving a mortgage commitment, and you could underwrite it on your own merit without our due diligence, would you be interested in lending non-recourse to these self-directed IRAs? And the answer was yes. The answer was yes. They looked at what the market was currently lending at, loan to values at about 60%, 55, 60%. They said they were very comfortable with that. Then here's the other thing. They looked at the current interest rates. Now, if you're to get a mortgage from North American Savings Bank or First Western Federal Savings, you're going to be in the mid-6s to mid-7s, depending on how aggressive you want to be. If you want a 3-year loan product, sure, 6.5. But if you want a little longer term, you're going to be at the mid-7s, low 8s, which isn't bad non-recourse. But guess what our lender said? Brett, how do you like 5%? 5% non-recourse. Current market loan to values. We have the most aggressive interest rates in the non-recourse space. And again, it only comes with our real estate because the banks have done their due diligence. They understand our management. They understand our company and how we buy. But it is such a phenomenal product that you won't find it anywhere else. So with the banks and partners that we have financing you, the real estate investor, non-recourse, at these phenomenal rates and terms, has given Growth Equity Group the opportunity to go out and buy developments. We've now done business in 7 states, right now heavily invested in Virginia. We have a few other hot zones that we're looking at property. But right now, the ability to buy and be able to leverage before interest rates go up, because it's bound to happen. And what happens when interest rates go up? Price of everything goes up. But if you buy this property today and lock in that mortgage with the low interest rates and lock in that price that you bought it for today, you're able to what? Take advantage of when the interest rates go up. Because guess what? The price of the property is going to go up, the price of rent's going to go up, and the interest rate's going to go up, what's going to subsequently affect your cash flow. So I cannot tell you how great of an opportunity it is, how phenomenal it feels to be a part of this, but it is one of a kind. We really have no competition because it is all done for you. This is really what we call the ultimate solution. Now let's talk about a little bit about Economics 101, because that's really what is happening. That's really what real estate is. And the biggest thing is understanding market cycles. Why market cycles happen. What is going to make for a good time to buy? Because right now, if you say there's good deals in Phoenix, you're incorrect. Property on the commercial level, and again, we buy developments, property on the commercial level is what we call in the business trading at a 2 to 3% return in Phoenix. Places like Miami, Florida, almost a 0 or a negative return. New York City, 1%. Think about this, though. I'm going to go back to Phoenix in Florida. We were in Florida in 2010 and 2011. It was a good time to buy. There's still a few deals going through the bank cycle in Florida, but it's very difficult to find the right deal. Now, to be in markets, and let me one more thing about Phoenix and Florida, and why we see it as one of those markets that is very difficult to be in, is because they didn't build for 5 to 6 years. So all of a sudden, confidence comes back in the market the last 2 years, and what happens? Everything gets taken off the market and prices skyrocket. Here's the other problem with those markets. With them not building for 5 years, it was difficult to raise rents because a lot of people weren't moving there. But all of a sudden, people are. And prices went up so fast, but rents are trailing in arrears. So if you're buying real estate there, you're going to buy it on a rent speculation. I don't want to be buying on a rent speculation because sometimes it's difficult to get that tenant who's used to maybe paying $1,000 a month when it should be $1,200 to understand and pay the market rent. So those markets are difficult to do business in. While we have done business in those markets, 2010, 2011, we're focusing on the markets that have the future and the real strong future growth. Cycle movements. We look at a real estate market cycle anywhere from 7 to 8 years. I cannot wait to not talk about the real estate cycle of 2008-9, what happened, because that wasn't real. That was banking. That was due to Wall Street. That was due to 40-point derivatives. That wasn't a real estate market cycle. That downturn was not a common real estate market cycle. What I foresee over the next 4 to 5 years, is we're going to see a little bit of slowdown in certain markets. Why? Again, I'm going to go with interest rates. We're going to see interest rates go up. But if you don't do your investing correctly, and if you calculate that risk and you go into the right conservative markets, I believe you'll continue to make money, without a question. And real estate is a localized phenomenon. So you want to be looking in those markets or utilizing Growth Equity Group for where we've done our due diligence and spent our professional time day in and day out. We live and breathe this all day long, where you're going to get those right buying decisions and be able to capitalize on equity growth, cash flow. It is incredible right now in these markets that we're focusing in on. So let's talk about the real estate market cycle in regards to feeling, because, right, we're human beings. We want to be buyers and sellers. We want to make the most money we can, but how should we be buying that real estate? Now, if you look at the far left side of the chart, between depression and hope, and then hope to optimism, that is between hope to optimism is where I want to be buying my real estate. Where I want to be selling my real estate, do I want to sell at Euphoria? Of course I want to, but am I going to take that risk? Have I been working with my associate at Growth Equity Group to tell me, hey, here's where we are. Here's what's happening in the market. We've seen a $20 per square foot, $25 per square foot growth in the market right now. We've had some other investors exit this property successfully over the last 3 months. It might be the right time for you to use this selling strategy. Guess where I'm going to do that? Right about excitement. Why? Well, if I wait for euphoria and something doesn't go as planned, I might end up at denial. And then what happens at denial? You hold, right? You hold because you think, oh, no way it could go to fear, but it does. So I want to be a seller at excitement. I don't want to scare anyone away from real estate investing and how difficult it is to get in and out of it. If you time your real estate correctly and have the correct partners around you, you will make money. Be aggressive when others are fearful. Everybody knows this Warren Buffett quote, but I couldn't say it any better. It's true. You have to be utilizing market timing right now. Think about it. What is going to happen in a market like the Hamptons Road area of Virginia? The $6 billion port expansion that is happening there isn't just going to go away. There is nowhere else for the ships to go. So if you're investing in this small sub-market today and get to utilize that in the future as where you are selling, again, you're going to do very, very well. Supply versus demand. We only buy real estate with less than 6 months supply. Now, what is supply? Supply is available inventory on the market today. Here's another great thing. We could develop real estate. We could build it ground up, bring in new townhome community in ABC mainland, right? But why aren't we doing that? Well, let's go back to the supply. I can buy real estate with under 6 months supply for what is called under replacement cost. Replacement costs are the cost to build the real estate today. Excuse me. Today, brand new. So if I could buy real estate with less than 6 months supply, rehab that property, and sell that property with new construction standards, and beat the guy down the street that will be building new construction, how am I doing for myself? Imagine this. Imagine if you buy a property for $120 a square foot, and the cost to build is $150 a square foot. Let's say you put in $10 to $15 a square foot into that property. Well, guess what? You're at $135 a square foot. Well, the builder who's building for 150 a square has to sell and make a profit, pay his expenses. Let's say that builder is going to sell at 180 square foot. What kind of leeway do you have in there to make money? It's incredible. The opportunity right now to buy the right real estate and to buy it with the right partners is here today. Think about it. The other thing is we purchase in bulk. So you get to utilize our bulk buying power. If I'm buying 50 units out of 250 in a complex, or you want to go out and buy one in that same complex, who's going to get a better price? Who's going to have non-recourse financing? Who's going to have in-house management? All of that is there for you. So when our acquisition team is doing their due diligence on any one market, a great thing and a great tool that we utilize is I like to say we can find out what's happening, we can see the future, is building permits. Has any real estate investor out there right now ever thought, hey, when I make my real estate investment, I'm going to go down to the county and I'm going to pull building permits to see not only what has happened over the last year, but what is going to happen. Most commercial developments will have to pull building permits 9 to 18 months before they even break ground. So when we talk about not only jobs, but if there's another apartment, if there's another home builder that's going to bring in a horizontal development and go vertical, I want to know these things as a real estate investor. So what our team does is we go in and we actually pull building permits and find out what is happening before we buy any one development. That's pretty cool, right? Average occupancy. Well, when we're doing our due diligence on property, we want to see what like-kind properties are renting for. Not only the price that they're renting for, but the occupancy. And how do you find this out? Where do you go to get this information? Well, there's always the local MLS, local realtors, newspaper. We can see what properties are being marketed, and then we simply call and find out. We ask simple questions. How many units are available? How many total units in the development? It's very easy to get this kind of information, but it's just one more step in the process to do the proper due diligence. Now, if you see here, the average occupancy on 8 like-kind properties in the greater Newport News area, 95%. That's about a 15-day-a-year vacancy rate. Is that good for a real estate investor? Absolutely. You see what is happening in this market. The jobs are coming in. Here's the other thing that we can take advantage of. Who's heard about millennials? Individuals 23 to 30 years old, graduating college at the age of 25, 26, 27, they used to be buying homes. Well, they're not buying homes anymore. They're renting property. Think about this Hamptons Road area of Virginia, where so many jobs are coming in. Do you think that it makes sense to own rental real estate where the jobs, where individuals 26, 27, 28 years old are making $50,000, $60,000, $70,000? Do you think those are good tenants? Absolutely. Take advantage of millennials. Sales and rent comparables. Those are 2 more things that we look at. Of course, we want to see what price per square foot like-kind properties are going for. What else do we look at? What are the rental rates based on bedrooms, bath size, amenities, management, and location? We're doing all of this due diligence to not only better our buying decision, because we buy everything as if we're going to sit there and own it, but to pass it on to our clients and investors. Average rental price in Newport News, Virginia, 2 bedrooms, right about $900. 3 bedrooms, right about $1,100. What this tells me is it's an affordable market to be investing in. Nobody wants to take the risk of owning investment property for high-end renters. That is very risky. Where I want to be as a property owner is I want to appeal to the masses. Here's another thing. We rent our properties at about 90 to 95% of market. That's how we underwrite the deal, and that's how we like to lease it. Why is that? Well, what costs a lot of money when owning rental real estate? Vacancy, turns, right? If I could say a little bit below market, what I'm going to do is I'm going to have more tenant pool to pick from, right? Because you have a good deal. Does that mean you have to give up your shorts and give up cash flow? No. Because at the end of the day, if you are making a double-digit return, cash-on-cash return, and you are keeping your property occupied and lived in, you're making more money than that aggressive investor who's out there pushing the market. Here's the Greater Hamptons Road area 10-year market appreciation analysis. Now, what does this tell me? We're seeing 3s, 4s, and 5s. Is it double digit? Is it up and down and up and down and up and down? Is it what we call a boom-bust market? Absolutely not. This market actually saw growth through the largest downturn in real estate's history since the Great Depression. So what this tells me here is, conservatively, when I do my numbers, if I'm buying a property for $100,000, how am I going to equate for appreciation? And that number that we use here at Growth Equity Group is, we'll just use an inflationary rate of 3.2%, being ultra conservative. We do not want to promise double-digit returns, or I do not want to be an investor in a market that they're going to tell me is going to have double-digit returns. I want to hear double-digit job growth and double-digit population, but don't pitch me a double-digit appreciation. I want a stable investment that's going to either grow my retirement account or simply grow my investment dollars. Inflationary rates. The government right now says we're at 2.2%. Who believes that? Not a lot of people. When you do not equate food into that number, how does that make sense? It doesn't make sense. But what does real estate do? Anytime inflation comes into play, what kind of asset do you want to own? Tangible. So again, when we look at our real estate investments, we're not going to promise double-digit appreciation because that's unrealistic. What we're going to use for that growth is the inflationary rate of 3.2%. Rents rising rapidly, folks. It's happening. Why is it happening? Well, this is a statistic from our friends over at Marcus and Millichap. And what I equate a lot of the rental rates rising so rapidly to is two things. One, when prices of property go up, leases will trail in arrears. So what happens is, if a property goes from $100,000 to $110,000 within a 12-month period, but the lease was signed at the beginning when the property was worth $100,000 for $1,000 a month, and over that 12-month period, the price went up, what's the lease still at? The lease is still at $1,000. So it trails in arrears and is always catching up. And what we've seen in really 2012 and 13 is when we saw the huge jump in prices, especially in those markets that were hurt the most. The other thing, I was just talking about it, millennials. More individuals are graduating from college, getting their first and second jobs, and not buying homes. Developers are taking advantage of it. Right here in Chicago, the last 3 towers that went up are luxury apartments. They were supposed to be condominiums. But what developers are doing is they're taking advantage of millennials. They're raising rents within these complexes and being able to sell them off as apartment buildings, where in the future, maybe 5, 6, 7 years down the road, another developer will convert them. But they're making more money. They're exiting the property faster, or some of them actually are getting long-term debt and holding the property and cash flowing it, taking advantage of this new generation, the millennials. Major employers in the Greater Hamptons Road, Newport News area, right here, Huntington Ingalls, the largest employer in the state of Virginia, who Forbes, again, just said, #1 state to do business in, is right here, right where our developments are, right where we're buying real estate. Okay? And all the other jobs, of course, in this greater Newport News, Hamptons Road area. Take out a map. Look at this area. It's a colonial area. There's not a lot of available land, which will only yield you greater returns, because when there's not a lot of land available, like Whole Foods paying 50% above market, what kind of opportunity does that make for you, the real estate investor? Huge. Should we buy home builder stock? A lot of people say, Brett, this seems hard. I don't want to do it. I don't want to deal with this. I'm going to simply go out and buy home builder stock. Well, is it volatile? Sure. Do you get to take advantage of cash flow? Depends. I don't know very many home builders, or none at all, that pay a monthly or yearly dividend, right? It's a gamble. Why not have a contracted return where you're signing a lease? You know your income. You know your expenses. Will things happen? Will a vacancy happen in the future? Yeah, but we equate for that. We put that in our calculations. Do we say, oh, well, maybe a fridge is going to go out, or maybe, I need to fix a furnace? Well, you know what? Those kind of things happen, and we equate for maintenance costs as well. So when you're looking at real estate, especially residential real estate, it's very easy to see and speculate what kind of return you're going to have in the future based on a pure cash flow analysis. I'm going to skim through here to show you a few slides of just what is happening in this greater Hamptons Road area of Virginia. This is American Airlines magazine. It's speaking about maritime travel and what is happening in this area and how it's actually becoming somewhat of a vacation destination. Canon is bringing in a $100 million project, manufacturing expansion, into Newport News, Hamptons Road area. Who wants to be a real estate investor in this area? Jobs, millennials. Ferguson, up 10%. Ferguson is a national home supply builder. They build mostly bath products. But what is happening in housing right now, they are taking full advantage of it. This is all happening in this small sub-market. VA gets a $12 million workforce grant. Newport News, 1,700 new jobs this year alone in this small community. You, the real estate investor, can take advantage of this. The port has $60 billion economic impact. The Port of Virginia, a $60 billion economic impact. Again, a lot of people do not know that this is happening in this area. The Port of Virginia is ready for the influx expected with the Panama Canal expansion. Right here, where we're purchasing real estate. Does it necessarily have to be a project that we have now? Doesn't necessarily have to be. But guess what's going to happen? Prices will continue to grow. The word is going to get out. Will you still make money here if you're purchasing in 6, 9, 12 months? Sure. But you're just going to pay a little more for it, right? Please check out our website, growthequitygroup.com. What that's going to show you is it's going to show you all these articles that we're skimming through quickly. You're going to be able to take the time, read them, and really dig into why this makes so much sense, why Growth Equity Group has made the decision that we've made to invest so heavily into this area of the country. Now again, what is the problem that we identified? Self-directed investors were going out there and they were buying real estate, but they were paying all cash for the real estate. Think about it. If you could leverage that retirement account, which you can, and double your buying power, how will your returns grow? Are they just going to double? Well, is that okay? Think about it. You're going to make more money on cash flow. You're going to make more money on appreciation because it's based on the inventory that you own. And again, we use that simple number, the inflationary rate of 3.2%. But you get all the advantages. Also diversification, different tenants. And your tenant's paying down principal, which is so important. Think about it. How do you make money in real estate, leveraged real estate investment? 3 ways, folks. Cash flow, appreciation, and your tenants are paying down your principal balance of your mortgage. That's real money. That's going back into your pocket when you sell the property. And again, non-recourse financing. Non-recourse financing, interest rates of 5%. It's unheard of in the industry. But we have them on every property that we sell. Again, you could walk in, purchase a property from us today, and be closing on it next week with a non-recourse loan in place. That's to say, if you had a self-directed IRA set up today with your custodian and you had it funded, you could do that. Or if you had cash on hand, a brand new LLC, all of those options are available to you. we'd love to take some time to speak with you about it and how it works. Now let's look at this cash versus leverage slide. In all cash purchase, if you had 97.9, and that's the property you were looking at, you would based on our fundamental numbers here of $970 a month in rent, your expenses, property taxes, association dues, management, monthly maintenance, you're looking at an internal rate of return of 12%. Now, if you were to buy 2 properties with Growth Equity Group and leverage it, you're looking at over a 22% internal rate of return. Is that good? Absolutely. Now I'm going to go through a couple of our recent acquisitions, kind of give you a background on why we bought them, what we did with the properties, and how the investment overall looks. So, Timberwoods Townhomes is an acquisition that we made mid-2014. It's a great development, a townhome development, but it's again right here in the wheelhouse of what the Panama Canal expansion is doing for the Port of Virginia. Quick reminder, investment of over $700 million into distribution centers, $250 million into new roads and railways, the birthplace of the U.S. naval fleet. The Port of LA, folks, I cannot tell you enough, is going to lose 25% of its business because of the Panama Canal expansion over the next 5 years. The deepest, most advanced port channel in America is right here at the Port of Virginia. I know I showed you this earlier, but here again, it's an illustration. If you're jumping on the webinar late, you're saying, why are they talking about the Panama Canal expansion? But the Panama Canal expansion, it's now up to a $6 billion project that is changing the way that America, once again, brings goods into the country from Asia. And there's one port that will allow for these large post-Panamax ships to come in, and that's the Port of Virginia. So here's some illustrations outside of our project, Timberwoods Townhomes, which is a townhome community right here in Newport News, Virginia. If you can see, it's right here at the right side. On the right side here, it's the bottom 2 X's, which is again our development. Gut rehab construction from the ground up. What you're looking at now is actually finished, is operating. This was really exciting for us. This was 2 units within the complex, centrally located, that instead of using one of the units as a management office on site, we took out a wall connecting the 2 units and made a large management and maintenance office, as well as a community room on the top floor and a community room on the bottom floor. Now, the top floor, of course, is huge. It's about 3,000 square feet. On the first floor, we have about an 800 square foot community room. But again, our maintenance and management is right here on site, staffed up for both owner occupants as well as tenants to be able to go pay their bills, speak to the HOA director, and speak to the property manager right here at Timberwoods. Here are some illustration or photos of what the property looks like. This again was a gut rehab project. The original development was built in the mid-80s, but we were able to go in, put new siding, new roofs, check out the landscaping. It's kept to the absolute T's. But this is the kind of property that we like to invest in. This is the property that's not only going to appeal to tenants, but when you go to sell the property, it's got great curb appeal. It's got a lot of good stuff going on, as well as, owner occupants who live there as well. I would much rather own a property that is a townhome in a community like this, that for one, I have Big Brother. I have the property manager there on site looking after my asset. But it's not an apartment complex. If you're a tenant at an apartment complex and you bring a date home, you're bringing a date home to an apartment complex. But if you bring a date home to a townhome community with owner occupants, with a front door, you have brought your date home to a home. Tenants take better care of properties that are fee simple deeded ownership rather than a 12 or 24 unit apartment building that everybody lives in an apartment, everyone's a renter, and everyone's going to tear it apart. Your turn costs are a lot less. Here's the typical finishes to the kind of product that we have. It's kind of funny, this paint here, which is perfect. It's neutral, it's inexpensive. The Sherwin-Williams down the street gives us a great price on it. It's actually called Timberwoods. They've named the paint color after it because of all the units that we've done within the complex. But again, this is to new construction standards. And what you can buy it for price per square foot compared to what the market bears in new construction is about 70% or 30% less, 70% of the cost of new construction. I'm going to go to our next acquisition, which is about 45 minutes away from our Timberwoods development, which is called Midlands. Now, Midlands is in the town of Williamsburg, which the town of Williamsburg is home to one of the nation's oldest, most reputable colleges, William and Mary. Our property here, which the state of Virginia is going through a huge growth, which the trickle down to the colleges is enormous. But William and Mary is actually walking distance. We have a walking path from our development directly to William and Mary. So we have grad students, professors, and individuals who work at the school as our tenants at this property. Does anybody invest in college towns? Does anybody invest in college towns in the #1 state to do business in? This acquisition is absolutely phenomenal. Here's an overall look. It's very much like our Timberwoods development. It has a front door. It's a townhome community again, which we love. You know, we purchased 32 units at this complex. Again, the curb appeal is fantastic. The overall community is kept to the T's. And it's just a great overall location and a great asset. Again, to be able to buy an asset for under $200,000 in Williamsburg is highly difficult. There's not a lot of available inventory. So the Midlands made all the sense in the world to us. We had to make a quick acquisition here. It was somewhat competitive. But again, I think we have a few units left for you. This is a great play in a great college town with a great backbone. Again, the overall look of the property, you have the great curb appeal, you have the fenced-in rear porches. It's perfect. It's perfect. And imagine owning this in your retirement account where you can leverage it tax-free or tax-deferred. And what you're going to see in the overall growth in a property like this. Again, the units are big, they're spacious, they're exactly what, that millennial is looking for. Again, that's our Midlands development. Now let's go back and just review everything that we've talked about on this video. Have we covered all the bases? Market timing. Growth Equity Group is out there timing the markets for you. Are we taking advantage of interest rates at all-time lows? Are we taking advantage of non-recourse financing? Are we leveraging our tax-free, our tax-deferred, self-directed IRA retirement account? Have we diversified our retirement account? That's a great question. Let's say you have $100,000 in a Roth IRA, and you wanted to stay in the market, but you also wanted to purchase real property with Growth Equity Group. Could you do that? Absolutely. You could simply roll, let's say you cut that account in half. You keep $50,000 stocks, bonds, and mutual funds, and you roll $50,000 to a self-directed IRA to purchase real estate from Growth Equity Group. A lot of our clients do it. You don't have to say, I'm either doing one thing or another. You can simply diversify. Should you protect yourself from inflation? If you kept the $100,000 in stocks, bonds, and mutual funds, how does that compete with inflation? It doesn't. It's paper. You have to have tangible real estate. What I like to say that I could throw a rock at, again, with calculated returns, with a lease, with your income and expenses. It's not that difficult, especially when you partner with the right company. Best markets in the United States. I think I've illustrated for you what is happening in the markets that we invest in and why it makes so much sense. Cash flow is king, right? Non-recourse financing. And we do not sell any property without a qualified tenant in place from day one. So I'd urge you to go to our website, www.growthequitygroup.com. We actually have 2 free books for you if you do go to the website. My favorite book, because I'm a contributor on it, is The 4 Greatest Challenges Facing Self-Directed IRA Investors Today. It's a quick, easy read. I think it's about 14, 15 pages. But it gets into the details of what I'm talking about, a little more of the guts of what those challenges are that these investors are facing today. Again, growthequitygroup.com. Send us an email, info@growthequitygroup.com, or give us a buzz, 866-904-3336. Again, 866-904-3336 is our phone number. Again, thank you for joining us. I hope I didn't take too much of your family's time, and please give us a call, and we'll talk to you soon. Take care. Again, I want to thank everybody for attending this informational and educational webinar this evening. I also urge you to pick up the phones and give us a call. We have a full staff here that stayed late, ready to field your phone calls, whether it's about self-directing, questions about the property, whatever questions you have. Pick up the phone. Our contact number is 866-904-3336. Feel free to give us a call right now. If you do have any questions, we can definitely get those answered. Again, have a great night, and thank you.